Welcome to the Steadyhand Year-End Review. I'm Tom Bradley, Chair and Co-Founder of Steadyhand, and I'm joined by two of my partners. Lori Norman is a senior member of our advisory team, and Salman Ahmed is our Chief Investment Officer. Our agenda today has three parts to it. I'm going to start off with an overview and update you on all things Steadyhand. Salman is going to dig into the specifics around markets and your portfolio. And Lori's going to get more personal and talk more specifically about what you should be thinking about. To those of you who follow our writing and watch our videos, we probably sound like a broken record. I'm not sure I mind that, because what you're hearing in different ways and at different times is at the core of successful investing. It's the wealth generation recipe that I've refined along with the team during 40 plus years of doing this. Things like diversification, time in the market, not market timing, never forgetting about valuation, keeping costs down to minimize lost return, and of course, staying steady. I've said for a while that it's been hard to be a disciplined, long-term investor in the environment we find ourselves in. There's so much noise that has no bearing on how your portfolio does. There always seems to be a sense of urgency, and today, the degree of risk-taking and speculation is off the charts. To illustrate why it's been so hard, I'll use those 5 investment tenets I just mentioned. For some, diversification is always tough to swallow because it means holding some things in your portfolio that are out of favor, securities that offer a good long-term return, and you'll be thankful to have when the market winds change, but they just haven't been doing anything for you lately. It's been even harder to stick to this because the last few years, the market hasn't been diversified. They've been dominated by a handful of companies, such that investors are asking themselves, why own all these companies? All I want is the magnificent few. Salman's going to talk further on this topic. If you need evidence of why market timing is so tempting and why it doesn't work, just look at the last decade. When Trump was first elected, there was despair. We felt it through our phones and in our meetings with you. What happened? Well, markets were off and running. The pandemic was going to change the way the world worked, and it did for a while. But 2020 turned out to be an excellent year for stocks. I don't remember a year starting with as much optimism as 2022, and yet, when interest rates increased, all the air came out of bonds and stocks. And finally, since 2022, we've been on a constant recession watch, but stocks have done very well. I think it's good to remember that market timing requires 2 reasonably correct decisions: when to sell, which, as you've just heard, is not easy, and when to buy back in, which, dare I say, is even harder. And if you get the first one wrong, the second one is nearly impossible. Now, what about valuation? I often quote Howard Marks of Oaktree Capital Management in this regard. He says, no asset can be considered a good idea or a bad idea without reference to its price. It's hard to argue with this logic, whether we're talking about bonds, stocks, cars, real estate, or even consumer products. But the importance of valuation can be forgotten for periods of time, which has been the case in recent years. The most expensive stocks have led the market charge, and it's gone on for an agonizingly long time, especially for firms like ours that are very valuation driven. As for fees, they also get lost in the shuffle when returns are good. Returns are up, so fees don't matter, except they do. They never go away. And they're one of the few things that investors can control. Let me give you an example. If you pay an extra 1% for a portfolio that earns 5 to 7% over time, that's a lot. It means that 15 to 20% of your return is getting eaten up. And finally, staying steady. It's in our DNA, obviously, and in our name. We know it isn't cool. Staying on plan is boring, especially when the information inputs around you are shouting, do something. But guess what? It works. If you've been with us a while, the proof is on the bottom right corner of page 3 in your quarterly statement. The blue line's not a smooth path, but it shows your portfolio market value heading steadily up and to the right. Now, what you don't see on that statement is our analysis that looks at how our clients do relative to how our funds do. And we can assure you that there's no slippage, no buying at the top, selling at the bottom, no active trading. In other words, no difference between what our managers are doing and what our clients are experiencing. And be assured that not all investment firms and certainly not all advisors can say that. So broken record or not, we continue to work on things that will help you be a disciplined long-term investor. In 2024, we enhanced our advice offering. We call it Advice 2.0, and it'll be, I think, quite evident to you when you listen to Lori in a minute. We accelerated the educational content at our YouTube channel. We published 30 videos last year, and just this weekend, my wife and I watched a latest coffee break video, which was super useful as we think about redoing our wills. And I encourage you, if you haven't subscribed to the Steadyhand channel, please don't delay. In 2024, the retirement withdrawal program finished its first full year, a year of having clients comfortable about where their monthly paycheck was coming from. It was also a year our fee reduction program put more money back in client accounts than ever before. So in summary, you can expect more of the same from Steadyhand in 2025. And you know what? We think that's okay. It may be even more important than ever. So now to dig into the investment side, here's Salman.
Thanks, Tom. I'd like to start by sharing our investment outlook with you. In the current climate, investors need to be extremely diligent because in our assessment, equity markets are behaving abnormally. And the strong returns over the last few years have been distracting investors from the problems that exist beneath the surface. But we at Steadyhand have been working hard to ensure that your portfolios are equipped to deal with these issues. So what is this problem I'm referring to? Well, the market is being driven by just a handful of companies today. In each of the last 3 years, just 7 companies, the so-called Magnificent Seven, have accounted for 40% of global market returns. Now, to put this into perspective, there are well over 3,000 stocks in the global index, and just a few are having this outsized impact. For example, last year, global markets gained over 28%. But without the Magnificent Seven, it was up much less, a little over 15%. And that's lower than what the Canadian market gained in 2024. It was up over 22%. Now, no one minds when the 7 are driving markets higher, but it is a different story when they're going down. This chart shows the global market returns with and without these 7 companies. And I'll draw your attention to 2022. And this year, stocks excluding the Mag 7 fell by 7.6%. But those 7 dragged markets down much further to 12.4% for the overall market. Now, to be fair, these 7 are not bad businesses. In fact, we own one of them, Microsoft. It's the largest holding in both the Founders Fund and Builders Fund. The issue, though, is that they're moving in sync. The 7 are moving as one. And the success or failure of the markets has become quite dependent on them. Now, you often hear us say that in challenging environments, investors need to stick to their plan. And in this challenging investing environment, we're following our own advice. We realize that you chose Steadyhand for peace of mind, and you expect us to stay disciplined when things aren't making sense, like today. And that's exactly what we're doing. We're following our 3 investment tenets: diversification, focus on price, and rebalancing. Your portfolio at Steadyhand isn't driven by just a few businesses. You own companies across industries, regions, and sizes. Even within industries, your holdings include companies that look very different. For example, Over 22% of the Founders Fund and almost 19% of the Builders Fund is invested in financials. This includes a company like TMX, which is the marketplace for stocks. It includes the major Canadian markets, including the TSX, the Toronto Stock Exchange, and the Venture Exchange. It also includes a company like Visa. And I don't think I have to explain Visa because you probably have it in your wallet. So your portfolios are diversified. We're focusing on price by staying away from speculative companies whose values today are driven more by FOMO than fundamentals. Instead, we own businesses with track record of profitability. And these days, it seems like there's a new AI company every day with a multi-billion-dollar valuation, and we're not dismissing AI at all. We see how it's changing the world. But we prefer to gain from it through established businesses that are already taking advantage. I mentioned Microsoft, which is among the leaders in cloud and AI. We also own Adobe, which is held in our global equity fund. It's seen wide adoption of its Firefly AI suite. We own Japanese robotics company Buoyant in our equity fund. It has long been a user of AI and continues to be one. And then we own Synaptics in our global small cap equity fund. This company makes technology for wearable and home devices. And with the increased adoption of these devices, Synaptics is gaining. Last but not least, rebalancing. We can't emphasize enough how important it is to rebalance in times like this. We've done so consistently ourselves. We've rebalanced the Founders Fund down to its target weights. In its equity component, we are slightly below our target of 60%, and the Founders Fund bond weight is close to its target, with the balance being in cash. Now, following these tenets has led to great results over the long term. We track the performance of the most prominent balanced funds in the country. Of the 25 with histories going back as long as the Founders Fund, only 7 have done better since the fund's inception. But the Founders Fund ranks even higher when you consider that our clients' returns are 0.3 to 0.5% higher by virtue of our fee discounts. But it is fair to say that these tenets don't feel good when markets are moving sharply in one direction, and they don't help performance in this environment either. Despite that, Steadyhand balanced clients saw portfolios grow by double digits in 2024. The Founders Fund gained over 10% after fees last year, while the Builders Fund was up over 14%. Now, again, keep in mind that many of you will have experienced higher returns by virtue of our fee reductions. I want to end by reminding you that we've seen this story before. Between 2007 and 2010, the Canadian market experienced something similar to what global markets are experiencing today. Back then, there was enormous excitement around resources. Oil and mining companies saw their stocks soar as investors expected never-ending demand for these resources. And the Canadian market, it just became driven by these companies. If you didn't own enough of them, like we didn't, you were considered ancient or out of touch. But the stocks got ahead of themselves. If you think about it, the predictions about resource demand were largely correct. Today, we use more oil and metals than we ever have. But many of the market leaders from that era have yet to get back to the heights they reached 15, 16 years ago. And something similar is happening today. And this is specifically happening with tech and AI-driven businesses. AI is already having a major impact on our lives, and we're only at the start of it. But like with resource companies, many years ago, the euphoria has caused the market to become detached from fundamentals. And it's exactly when those investment tenets I've been talking about, diversification, price discipline, and rebalancing, matter most. We came out of that experience with resources smelling like roses. Our market-beating returns in the years after resource stocks corrected contributed to those strong long-term numbers you saw earlier. And we are confident the same will be true this time.
2024 reminded us how dynamic and interconnected the financial world is. While stock markets were up considerably, your concerns around inflation, interest rates, and managing debt versus investing were top of mind in our conversations with you. The excitement around artificial intelligence and the Magnificent Seven tech stocks captured headlines, while geopolitical unrest in the US election added layers of uncertainty. Closer to home, inflation eased, bringing some much needed relief. We saw modest adjustments to pensions like CPP and OAS, while the TFSA contribution room held steady at $7,000 for 2025. A series of rate cuts by the Bank of Canada from a high of 5% in April 24 to 3.25% today helped lower borrowing costs, but also brought down GIC and money market fund yields. In conversations with you, we've seen some clear priorities emerge this past year. Many of you have remained focused on paying down debt and avoiding new credit. Whether for a new home, home improvements, a car, or a vacation, many of you have a plan in place and are continuing to save rather than borrowing. Setting up monthly automatic contributions into your accounts has been a game changer for many of you and an easy way to build wealth steadily and effortlessly. Lastly, enrollment in our Steadyhand retirement withdrawal program has grown, and our quarterly rebalancing guidance ensures your portfolios have stayed aligned with your withdrawal needs. While some of these may seem like an obvious to-do checklist, they aren't always easy to implement. It's been great to be part of these conversations with you. As we look ahead to 2025, markets will rise and fall. It's the nature of investing. While uncertainty can be unsettling, it's absolutely natural to feel the urge to protect your investments. Staying focused on what's within your control can make all the difference. What we're doing for you, we're rebalancing regularly. We ensure your asset mix aligns with the goals you're working toward. If you're invested in the Founders and Builders Fund, this rebalancing is handled regularly on your behalf. Across our funds, we've built well-diversified portfolios that span various sectors and geographies, particularly within the Founders and Builders Fund. For those investing on your own, try to remember to avoid overexposure to any single sector or stock, as it can increase risk. And while other firms get headlines for lowering fees on a few of their funds or services, your fees come down year after year as your portfolio grows and you're with us longer. We're proud to be the only firm in Canada that rewards loyalty by reducing your fees based on how long you've been with us. Our advice for you as a CEO of your own money is continue to build cash reserves. For anticipated expenses in the next 1 to 3 years, consider moving gains into our savings fund or a high interest savings account. This ensures your funds are readily available when you need them. As Tom recently wrote, savings isn't something you should have to think about daily, and I couldn't agree more. Automate your savings with monthly contributions and let them grow effortlessly in the background. Resist the temptation to time the market. Stick to your plan, revise if necessary, but always have a clear strategy. Avoid making emotional decisions in response to market volatility whenever possible. We'd encourage you to check in annually to ensure your goals are aligned with your investments. Think of it or us as your accountability partner for your financial journey. As we shared in November, we fully embrace Advice 2.0. Whether you need help starting a plan, refining an existing one, or thinking about retirement, our team is here to support you, so please reach out to us. If you're interested and curious, there are countless resources to explore. Our Steadyhand blog, newsletter, cafes, and more recently, our YouTube channel are great places to start. And I'll end on a note of gratitude. Your trust in us is the foundation of everything we do. Thanks to the referrals and introductions you've made to friends and families, we have and will be planting close to 5,000 trees since we started this program 2 years ago. A small but meaningful way to give back and invest in our collective future. From all of us at Steadyhand, Tom, Salman, myself, and the entire team, we wish you and your loved ones health, happiness, and success in 2025. It's wonderful working with you, and we genuinely enjoy being part of your journey.